Somewhere in your national insurance record right now, there could be a single missing year sitting quietly in the background, and that one gap could end up costing you thousands of pounds in retirement without you ever knowing why. What if I told you that most people never check this record until it's already too late to fix it? This isn't a small technical detail you can ignore. This is something that directly decides how much state pension actually lands in your bank account for the rest of your life. Welcome to the channel. If you're here, it's because you want the truth about your money laid out simply, without the confusing jargon, and without anyone trying to sell you something you don't need. So let's slow down, breathe, and go through this properly, step by step, so you know exactly where you stand. Here's what's actually going on. Your state pension isn't based on how much you earned during your working life. It's based on something quieter, something most people barely think about. The number of qualifying years sitting on your national insurance record. Every year you worked and paid national insurance, or received certain credits while unemployed, caring for someone, or claiming particular benefits, that year usually counts as a qualifying year. Stack up enough of these qualifying years, and you build toward your full state pension. But here's where things start to get serious. If even one of those years didn't get recorded properly or simply never happened because of low earnings, unemployment, time spent abroad, or a career break, that year becomes a gap. And a gap doesn't just sit there harmlessly. It quietly reduces what you'll receive, sometimes by hundreds of pounds a year, for every single year you live in retirement. Now stay with me, because this next part is where most people get caught completely off guard. To receive any state pension at all, you generally need a minimum of 10 qualifying years on your record. To get the full new state pension, most people need around 35 qualifying years. That gap between 10 and 35 is enormous, and a lot of people simply assume they're further along than they actually are. They assume the years add up correctly in the background, automatically, without anyone needing to check. But wait, it gets even more surprising, because national insurance records are not always accurate. Employer errors, periods of self-employment with unpaid contributions, time spent working or living outside the UK, even old contracted-out pension arrangements from decades ago. All of these can quietly create gaps or mistakes that sit in your record for years, completely unnoticed, until the day you actually go looking for them. And this is what most people are not being told clearly enough. By the time many people first check their record, they're already close to retirement age, standing there with far less time to do anything meaningful about it. That's the real danger here. It's not that gaps exist. Gaps are normal, and plenty of people have a few here and there. The real danger is discovering them far too late, after the window to fix them has quietly closed or narrowed down to almost nothing. So why does this matter so much right now, in 2026 specifically? Because the rules around fixing these gaps have changed. For a limited period, people were allowed to fill gaps going all the way back to 2006, which was an unusually generous window compared to normal rules. That extended opportunity has now closed, and it closed for good on the 5th of April, 2025. Under the standard rules that apply going forward, you can only fill a gap within 6 years of the end of that tax year, and this is not one single fixed date for everyone. It's a rolling deadline, one that moves forward every single year. Right now, that means a gap from the 2020 to 2021 tax year needs to be filled by the 5th of April, 2027. A more recent gap, say from 2024 to 2025, doesn't need to be filled until the 5th of April, 2031. So the exact deadline depends entirely on which specific year the gap sits in, not on some single countdown clock ticking for everyone at once. What stays the same for every year is this hmrc. Once that particular year slips outside its own 6-year window, in most cases, it becomes permanently unreachable. Not delayed, not postponed, gone. Now this could affect your future in ways you didn't expect, especially if you've had any career breaks, time spent self-employed with irregular contributions, periods living or working overseas, or even a few quiet years where you simply weren't paying close attention to your paperwork. None of that makes you unusual, it makes you human. But it does mean the odds of having at least one gap sitting somewhere in your record are higher than most people assume. And every year that passes without checking is a year closer to certain older gaps becoming permanently out of reach. Let's talk about the money itself, because this is where the emotional weight of this really lands. Filling a single qualifying year currently costs just over £900 for a full year under the standard rate, though the exact figure can vary a little depending on your specific circumstances. On the surface, that sounds like a real expense, and I understand why some people hesitate right there. But here's the part that changes the entire calculation war, that one-off payment isn't a purchase you spend once and forget. It can permanently increase your annual state pension for the rest of your life, every single year you're retired. For many people, the amount they gain back in extra pension over just a handful of years in retirement completely outweighs what they paid to fill the gap in the first place. It isn't automatically the right move for everyone, and I'll come back to that in a moment, but for a large number of people, it is genuinely one of the highest return decisions available to them. And just when people think they finally understand this, they miss one key detail that trips almost everyone up. Filling a gap is not automatically the right choice in every situation. If you already have enough qualifying years to reach the full 35 needed for the complete new state pension, paying to fill an additional old gap won't increase what you receive at all. It simply won't make a difference no matter how much you pay. Similarly, if older contracted-out pension arrangements or certain protected payment rules apply to your specific record, the maths can shift in ways that aren't obvious just by counting years on a page. This is exactly why guessing is so risky here, and why checking your actual personal forecast matters more than following a general rule you heard somewhere online. So here's how this actually works in plain simple terms. You can check your national insurance record directly and for free, either through the government's online portal or through the hmrc app on your phone. It shows you clearly how many qualifying years you already have, whether any gaps exist, and in many cases, it will even calculate whether paying to fill a specific gap would actually increase your state pension, and by how much. This single step is the one most people skip entirely, simply because they assume everything is fine until proven otherwise. Don't be that person. Checking takes a matter of minutes and it costs nothing at all. If the record shows gaps, the next step is requesting your personal state pension forecast, which tells you specifically what you're currently on track to receive and whether filling particular years would genuinely raise that figure. If it confirms that filling a gap will help you and you can comfortably afford the one-off cost, that's usually when it becomes worth seriously considering, especially if you're reasonably confident you'll be drawing your pension for a good number of years once you reach that age. If the forecast says filling a gap won't change anything for your specific situation, then you've just saved yourself from spending money on something that wouldn't have helped, and that clarity alone is worth the 10 minutes it took to check. If you ever come across a gap that genuinely shouldn't be there, a year where you know you were working and paying in, but the record doesn't reflect it, that's not something to just quietly accept either. You can and should contact HM Revenue and Customs directly to query it and get your record corrected. Genuine errors do happen, more often than people realize, and they don't fix themselves sitting in a database somewhere. They only get corrected when someone actually asks the question. I want to bring this back to something calm and grounded before we finish, because none of this is meant to alarm you unnecessarily. This isn't about panic, it's about awareness. The people who end up disappointed by their state pension in years to come are rarely the ones who checked early and made an informed decision, even if that decision was simply to do nothing, because their record was already solid. The people who end up disappointed are almost always the ones who never looked at all, who assumed the system was quietly taking care of everything on their behalf, until retirement arrived and the numbers turned out smaller than they'd imagined. If you've made it this far, you now understand something that a huge number of people your age still don't, and that puts you firmly in control rather than caught by surprise later. This isn't just a piece of financial trivia. It's a genuine, practical step that can protect real money, sometimes thousands of pounds, over the course of your retirement. Go check your national insurance record today, while the current window to fix anything is still open, not the week before you retire, when the choice has already been made for you. Stay informed, stay one step ahead, and subscribe so you don't miss the next update the moment the rules shift again.